good news, bad news. If you can ride out the odd 50% decline, totally unnecessary, of course, on fundamentals 30 years ago. The market is mildly hysterical from time to time, and it's totally unjustified by the steady stream of dividends and earnings. But it happens. And if you want to ride those 50% drops, good luck. It works out very well in the long, long run. But it can take you 20 years to get back in the game. If you get caught in 1929, it works out just fine, but you don't get your money back until 1955. If you get hammered in 74, you don't get your money back until 87. And then when you've gotten it back for a month or two, you give it up again. And the same in 2000. By 2010, you're still losing money. So you have to be willing to ride out. And some people feel their lives aren't long enough to take the 10, 15, 20-year wipeout. So for those who feel they're brave enough and willing to try, I've always thought that sidestepping some of the pain might be a good idea. I think they're perfectly straightforward. They're intellectually easy and psychologically disastrously difficult. They're easy because in most cases, they're so extreme. It's like, how do you notice the Himalayas when you're standing in northern India? I mean, they come out of the plane and they soar up. You can't miss these things. 1928, 29 was just such a massive rally. So the sheer price rise, you can't miss. Secondly, just to make it easier, the great bubbles have always tended to rise faster and faster towards the end. And that's a kind of defining feature also. And then thirdly, they have all been accompanied by massive, public, obvious, crazy behavior, where the headlines migrate from the financial page to the front page, where they migrate to the opening few sentences of the evening news on the radio or the television. And they talk about market new highs, and they talk about what the Bitcoins of the era have done. I know it's not a stock, but it's a speculative instrument, and the GameStops of the world. And back in 2000, most of you will be old enough to remember the pet.coms and the utter craziness of that period. And the same was true of 1929. The same was true of Japan. We had a group from Salomon Brothers, a leading American brokerage house of the era, who came around in 88, 89, when Japan was moving to 60 times earnings, and explaining that their yields, et cetera, and their interest rates, et cetera, they really should have been selling at 100 times, and they were cheap, and you should buy them. And it didn't stop the Japanese market breaking the following year. It has not recovered the high of 31 years ago yet. So that was pretty painful. Taught us, in a sense, a powerful lesson about how human behavior works. But it also explained to us why the big firms couldn't play that game. It is simply not a commercial proposition to get out of a bull market, because every now and then they run further and faster than you expected. Japan went on and on and on, way beyond people's expectations. 2000 beat the record. There's a lot of difference between 35 times earnings and 21, the previous record. So sometimes they break out to an astonishing degree. Now, the bad news is that changes nothing. They go back even more and longer, and they go back where they came from. And the higher they go, the harder and longer they fall. But it changes everything when you're there. When you're having a bubble, it's really advisable to have the bubble be in one focused area. In 2000, for example, it was US growth stocks. It was not global. And real estate was really cheap, as in cheaper than the cost of building the building you could buy real estate for. The bonds were really cheap, and inflation-protected bonds had just come out, and they yielded 4.2%, 4.3%. I mean, can you believe it? Real return guaranteed against inflation.
Want to trade and invest in global markets with ease? Build your portfolio with a one-stop investment app. Moomoo offers access to stocks, ETFs, options, and more. Click the link in the description and make a deposit to claim your free stocks.
Even within the market, the value stocks were not too bad and the small stocks were not too bad. And small value was actually cheap enough that when the S&P had gone down 50%, it hadn't gone down at all. It was, I think, +3. I mean, amazing. And the REITs, all of the real estate, they were up 30% as the S&P hit -50. That was a bubble that was paradise for an asset allocator because there were so many alternatives. What you want to avoid is what Japan did in 89. Japan had the biggest bubble in history, I believe, bigger than the South Sea bubble, and that was in land and real estate. And the old story, the land under the Emperor's Palace was worth more than the whole state of California. We spent 2 days actually asking and digging, and it was. It literally was. First of all, it's a big palace with great palace grounds. And secondly, downtown Tokyo, all around it were selling for, 4, 5, 6 times downtown Manhattan. And the numbers worked out. Just amazing. Simultaneously, they had the biggest equity bubble of any important market. There are some flaky, tiny markets that don't count. But of any major market, that's the biggest bubble of all time. At the time, we were told it had gone to 65 times earnings. There's always historical revisionism in the data, so you have to be a little careful. But at the time, it was clear, everybody agreed, 65 times earnings, which is pretty remarkable. And it had never sold at over 25 times before. So that's the thing that makes every value manager wake up sweating in the middle of the night is Japanese stocks. Anyway, they managed to do both of these at the same time. And 31 years later, the land is not back, real estate's not back, and stocks are not back to where they were. This was a loss of perceived wealth so profound that you have to congratulate the Japanese for not going into a depression. And people talk about a lost decade, but that was a lost decade where they actually inched forward. They actually did not go even backwards for the decade. When you're taking that kind of loss of wealth, you're in trouble. Now, in the so-called great financial crash, which irritates me as a title because I think it was a housing bust, the housing market had this perfect 3 sigma, 1 in 100-year outlier bubble. It had been very, very stable historically. So to get to that level, it only had to go up only, he says, about 40% or so in 2 to 3 years, which it did. And then it gave it all back. But the trouble with 2007 housing bubble is it took the stock market with it. The stock market was not sensationally overpriced, but it was a big overpriced bull market. It was not in itself a bubble. The housing market was a bubble, a beautiful, magnificent bubble. And if you look at it, it's perfectly round. It goes up for 3 years. It goes down for 3 years, exactly the same speed. And it goes all the way back where it came from. And the housing bubble inflicted about $10 trillion of loss of perceived value. So 1 minute you thought your house was worth 400,000. 3 years later, you were told it was worth 550,000. 3 years later, you were told it was 400,000. And 2 years after that, 350,000. So you had lost an enormous asset. And housing markets are much more dangerous because more people own them. The middle class in particular that owns very little stock owns a lot of housing. And it really, when you lose that value, you skip the trip to Portugal and you realize you can't send your second son to private school. And it really flows through the system. Don't do it. So what do we have this time? We have, of the 4 major asset classes on the planet, we have 3.5 in bubble land. We have, Jim Grant would say, the most overpriced bond market and the lowest rates in the history of man that go back 4,000 years. There was never a time when so much had a negative return where you pay the government to take your money. So that's number one. Number two, we're a contender for the highest priced US equity market in history. I would say a majority of bubble experts think this is now slightly higher than 2000, which was epic. And some people do not, but at least we can all agree it's a contender. And then we have real estate. And real estate was kind of off screen until a few minutes ago. And suddenly, on some of the databases, it has risen 20% in the last 12 months. Schiller's series, a little more conservative, lags quite a bit. I think it's only up 13, but the other series, perfectly seriously done. Up 20 is the sharpest rise, sharper than the 70s with inflation and sharper than the housing bubble of 2005. And what that means is metric we hero worship is multiple of family income. How much does the median house, the one in the middle, how many multiples of the median family income is? It's a nice, stable, fair metric. It used to be in America that we'd sell at 3 times family income. And in the bubble, we kind of went to 4.5 or so and then back. And we are now at the multiple of family income that we were in 06, the very peak of the housing bubble. We're back. Now, the rates are very low, so all being well, you can, quote, afford it. What you can't afford to do, if you're a beginner, is buy it in the first place. How painful for most people high asset prices are. They're kind of fun when you own them. They're great for retirees who have nothing to do but liquidate their pile of assets. But for people who don't have it, and for society in general, it's a disaster. Because what has happened over the last 25 years is that the yield on assets has dropped as the price rose. And at 6%, you can reinvest and double your money in 12 years. And at 3%, it takes 24 years. So in 48 years, you have a quarter of the wealth, ignoring taxes for a second, a quarter of the wealth that you would have had in the world on average of the 20th century. This is terrible. And the same with a house, you're getting half the house that you used to get for your income. It's a disaster for people who don't have assets. And the whole society is compounding its wealth much more slowly. It's such a simple arithmetic point, but nobody seems to get it. It is slowing our wealth creation down and giving us the illusion that we're all getting rich. And of course, if you have a house, you know that the house hasn't changed. House was the same house at 300,000 as it was at 450 and back to 300,000. It's the same darned house. It doesn't hold off the rain any better in a housing bubble like today. It's the same with stocks, by the way. They're the same old stocks. Only in stocks, you get the fantasy of pretending that somehow their earnings have gone stratospheric. And you can expand the storytelling to fit the available price. And that's why bubbles in the stock market are so dangerous. But when you look back, you find there was no dramatic shift in long-term earning power in 2000. It was just a game we all played. There wasn't even in Japan. There was a fairly modest upswing in profit margins. And profit margins are, as I like to say, the most provably mean reverting series in economics. So if you pay up for rising profit margins, that is absolutely the wrong thing to do. You should pay up for crushed profit margins because they always bounce. You should pay down for heroic profit margins because they always move downwards. Anyway, so here we are. We have the trifecta. First time in American history, the real estate market, the bond market, and the stock market. And then coming up on the rails, as they say, are commodities. If you take the Goldman Sachs index for non-energy, they have a ludicrous total index. It's so dominated by oil that when they break out oil and non-oil and the total index, you can't tell the difference really between the total index and the energy part. But if you look at the non-energy part, which is all the metals, all the critically important foods, plus one or two other things like cotton, it's back to the all-time high of 2011. It's back to that epic move in commodities. I mean, who knew that? The broad base of commodities, a lot of them that count, are back to the all-time high. And the UN Global Index of Food Prices is not far off its 2011 high. And then there's a more complicated story of energy, because energy in terms of fossil fuels is in the end game. The paradox, or the slight irony here, I suppose, is in the stock market, where it really is focused most on the US. And although the developed countries are, quote, overpriced, it's fairly business as usual. And there are some countries, the UK, for example, and some would argue Japan, are not particularly expensive. And emerging markets seem to be perfectly ordinary, which means against the bubble US, they're one of the 2 or 3 lowest relative points in history. And from those other points, they have done very, very well indeed. As recently as 2008, emerging markets sold at a PE premium to the S&P, and now it sells at half. And that's a pretty decent discount.
Why does this time seem very, very different?
I am actually hard-pressed to find anything that isn't different. But to start with the basics, the price-earnings ratio of the market for the last 20 years has been 70% higher than the previous 100 years. This is not a small number. This is not 15%. The profit margins of US corporations have been 30% higher in the last 20 years. So you've had really profound shifts. I think also the style of corporate management. 30 years ago, they used to think about expansion. The market for paper would get a little tight and they'd start to open new mills. Now they think about profit margins more than expansion, and they use their extra money to buy stock back. It works out very well for corporate offices, tends to push the price of the stock up a little bit, tends to be a little bad for GDP growth, a little bad for jobs. But for the corporation itself, it works pretty well, and for the stockholders. And there's no easy correlation between the economy doing well and the stock. You might think there is when you read the newspaper or listen to the news, but there isn't. If you run a correlation between the countries that do well, you can't find any connection. Rapid growing countries of the past have tended to slightly underperform. So you might start with Japan, had the best growth, didn't do that well overall. And then South Korea, China today, they outgrow everybody. It doesn't mean you make more money in the stock market. In fact, you run them all together over the last 100 years, you see a slightly negative correlation. The countries that have grown more slowly tend to do a little bit better in the market. The thing that drives return is how profitable you are, not how fast you grow. I'm causing a lot of trouble amongst my fellow value managers by saying that I don't think this market is a true bubble about to blow up, but that doesn't mean I would put my money in the US market. I think emerging markets is unusually much cheaper than the US. As recently as early '08, it sold at a premium in the price-earnings ratio. And by the spring of last year, amazingly, it was actually cheaper than it had been after the crash in '09. And the US, meanwhile, priced at 11 times earnings, had gone to 22, and emerging had gone from 11 to 10. So a huge divergence in favor of the US. And that's usually a pretty good sign. You should pay attention, be ready to be a little brave, and the probability of emerging not outperforming the US over the next 5 or 10 years is, I think, very slim. It will win.
Who has the strongest economy in the world? And how do you measure it?
I think, obviously, China and India have been able to outgrow everybody else, and I think that's a workable definition of a strong economy. How many of your poor have you turned into middle class? What is the average lifestyle? What's the average educational standard? And you have to give it to the Chinese. What should scare us a little bit is the success, particularly of the Chinese, of educating their average workforce. Their recent scores in math are higher than the US. Not only are they 1/3 the price or 1/4 the price, but they're actually more skilled in basic quantitative methods. This should make us nervous. It makes me nervous.
Exactly. It makes people in Silicon Valley nervous, too.
I think it does, yeah.
Yeah. Now, can you argue that over the long run, whatever the long run is, those countries that don't have a highly functioning democracy will be, in the long run, restrained in terms of their prospects?
I have this view about capitalism, that it does millions of things better than other kind of top-driven economic systems. But one or two things it does very badly. If it's very long-term, capitalism is not really suited to that. They have this discount rate problem whereby anything that happens out 20 years doesn't seem to matter. And the Chinese can deal with those problems much better. And today, the real threats tend to be long-term issues such as climate change, population. How do you deal with these problems, which are what economists call externalities mainly? Their societies, I think, can and are handling it much better. They respond to climate change much more quickly and more seriously than we do. And they have much greater respect for science. So I think the biggest risk to